right, so first we're going to hear from John Riggs at Lucent Alcatel. John, welcome. Please take a moment to explain what your company is doing in corporate venturing, and then I'll have a follow-up question for you as well.
Great. Thank you, Henry. My name is John Riggs. I'm the head of Alcatel-Lucent Ventures. That's the strategic investment organization within Alcatel-Lucent that's focused on commercializing innovations to drive breakthrough results. Within Alcatel-Lucent Ventures, we take a three-pronged approach to corporate venturing. We have a focus on internal innovation, incubating ideas that come from within Alcatel-Lucent to grow new businesses organically from within the company. We also focus on external investment. That's a focus on open innovation by investing dollars in companies outside of Alcatel-Lucent that represent strong strategic alignment with the vision of our company. And lastly, we also have a joint venture effort, looking at coupling or collaborating with those that are very well practiced in a particular vertical industry, such as healthcare, coupling that with the innovation excellence of Bell Labs to drive new opportunity for the company in terms of commercializing new product.
John, thank you very much. Now, inheriting the legacy of Bell Labs on the one hand, and of course Alcatel in France on the other, how has it been to introduce this venturing model into these two very well-established traditional companies?
The question that you're asking, Henry, I think really speaks to the question of impact. What's the impact of corporate venturing for Alcatel-Lucent Ventures? What is our mission? What is our focus within the context of the corporate setting, within the context of the legacy of Bell Labs? Well, as we look at our mission, as we look at our mantra, it has evolved. And I believe that's something that's true of every ventures organization. If it looks at its history, its relevance within the corporate setting, it's a study of evolution within the context of the corporation's goals. So I'll just tell you a quick story as it relates to our mantra. Our present mantra is innovation, excellence, impact. Innovation, excellence, impact. But impact is something that has definitely evolved within our model. As I consider our beginning in 2005, when we were founded as a ventures organization, the initial focus was on rapid product commercialization, bringing new ideas to market with excellence, with quality, but also with speed. It was a focus on harnessing innovation, a focus on infusing entrepreneurialism into the company. But that definitely evolved. It evolved to the midpoint of our lifespan, as it is, 5 years, to having an impact on the business results of the company, to serving as a source of new business growth, a new growth engine for the parent company, aligned with our corporate strategy, but striving to incubate that one venture that can change the growth trajectory for the company. This idea of every company having just one innovation that can take them to revolutionary success. And that's the latest emphasis. It's having a portfolio of things that we're investing in, but recognizing that by being in the game to win the game, we can be just one innovation away from breakthrough results.
John, thank you. Let's get another perspective here from Stefan Heuser from Siemens, Technology to Business. Stefan, welcome.
Good morning.
Great to see you.
Thank you.
So, Stefan, I've already introduced you as Siemens Technology to Business, not Siemens Corporate Venture Capital.
Right.
Obviously, you've given a lot of thought to this different label for what you're doing. So tell us why you called this, tell us what you're doing, and why is it called Technology to Business?
Okay, so maybe before I tell you what we're doing, I'll tell you what Siemens Venture Capital is doing. And so we basically have two organizations in Siemens focused on venture and on innovation. Siemens Venture Capital is basically more like a typical corporate venture organization, and we would invest in companies which have early revenue, which have a product on the market like a at least a product to start with. And so from that point of view, you have others like Intel, etc., who are very similar from this model. Siemens technology to business is focused on, we call it an outside-in model. And so the base behind is that we believe there is many innovations in organizations outside of our own R&D. And if you think what a company like Siemens is spending in R&D, it's in the 3 billion euro range. It's a massive amount of R&D which is spent and ideas to kind of develop internally. And you may guess that most of these 3 billion are actually spent in more the development side and less the research side, which is typical for all the big corporations. So we believe there is much more innovation out there in startup companies, in universities, in research labs, etc. And that's what we're trying at Technology to Business, is to get the technologies from these sources, startups, universities, labs, into Siemens in an appropriate way. And basically have two tracks. One is that we kind of run an internal startup. So we start with an innovation from the outside, let's say from UC Berkeley, and develop it to a point where it becomes an internal business. And we apply all the criteria which you would also apply to an external startup from a competition point of view, from product strengths, etc. But then the other thing we're doing is we invest in very early stage startup companies. And these startup companies are basically two guys, literally two guys in a garage in Berkeley or somewhere else, where we put somewhere between $500,000 to up to $1 million into these companies and try to develop them and help them to sort of go through the phases of a startup, making the first A round and gets investments from other VCs. And the reason here is not necessarily first for the return of investment, it's really in creating a very early stage partnership. And that's a difference if you look to the traditional corporate venture model, where already the company is out there for a few years. So we believe that way we connect with startups like 2 to 3 years earlier than traditional venture capital. And due to this, make a connection at a point where typically big corporations like Siemens are not capable to connect with startups. And we treat these very well, I would say, as partners and try to develop a business together and go from there.
So in contrast to what I said about Xerox, and I think even to what John was saying about Alcatel, you don't incubate activities to spin them out. You are incubating ventures to spin in to Siemens.
That's correct. So we have another organization.
No, that's fine. I just want to make sure what you were doing. Yeah, we're going to follow up with all of you again, but I wanted to just clarify that's a very interesting way to think about incubation, to get something ready to be a small entity brought into a very, very large company. How do you get it ready to be successfully introduced into the large company? Very interesting.
This is correct. And just to clarify, we have an organization called Siemens Technology Accelerator, and they do exactly the opposite. So they do the spin-outs. So they're technologies from Siemens and try to commercialize them as a new startup or as a technology sale, etc. But this is sort of an inside-out. And what our focus is an outside-in focus, that we're trying to connect outside innovation with Siemens. And that's one of the things for startups in an extremely early stage. It's very difficult to connect with big companies like Siemens. So if a startup, somewhere two guys in a garage are calling Siemens Germany in Erlangen and try to get somewhere, it's not easy to get the right person, etc. But using us in the middle, sort of TTB, Siemens Technology to Business in the middle, we basically can make the appropriate introduction and basically connect the right people, and we have sort of the credibility in-house to move things forward.
Thanks, Stefan. Let's get a perspective now from the life sciences, and welcome to the stage Campbell Murray, Managing Director at Novartis Ventures. Campbell, welcome.
Thank you. Pleasure to meet you.
So Campbell, give us a perspective from the life sciences on corporate venturing and corporate venture capital.
Will do. Well, it's a pleasure to be here. Thank you. Barcelona is a beautiful city. It's my first time in the city. Our fund was created in 1996 when Novartis was formed. At the time of the merger between Ciba and Sandoz, which at the time were two of the big three Swiss pharma companies, Sandoz realized that there would be regulatory angst and probably public angst within Switzerland at the loss of jobs that often results from a merger with the synergies of a merger. So they created an independent trust, and on the day of the merger announced the formation of an independent fund. And the reason I go back to the history is our fund is a little bit unusual for a corporate fund in that when we make investments, we do so without regard for Novartis corporate strategy. And we do so without regard particularly for Novartis pharmaceutical strategy or Novartis research strategy. And paradoxically, or counterintuitively, we've actually found by doing that we've been far more strategic for Novartis. And when we've analyzed our results, we've had a lot greater impact for Novartis Pharmaceuticals and Novartis Research by operating completely independently and making our investment decisions purely focused on the returns financially and for the product than we would otherwise have made. And I think it comes back to a point in common with Stefan from Siemens when he pointed out that Siemens is spending €3 billion a year in R&D. So for us, Novartis spends around 6 to 7 billion a year in R&D in euros. You know, Pfizer, all of the life science companies, Roche, they're all spending between somewhere around 6 to 10 billion euro a year. And if you're the average life science venture firm, you're probably spending at most 100 to 200 million a year on new investments. So it's nothing. It's a drop in the bucket compared to what your pharma LP parent might spend. If you spend in areas where the farmer is devoting a lot of resource, it's a terrible idea. I'm trying to think of a polite way of saying it, but you're unlikely to have significant impact. Where a venture capital firm should be investing is in the technologies that are going to transform your particular focus in the next 5 to 10 years ahead. And I think the only criteria you should be using to make investments is the likelihood that the product will help people in the future, whether it be IT or healthcare. So for us, our investment criteria are completely made within the team of 8 investment professionals, 4 in Boston and Cambridge, 4 in Basel, Switzerland. We have a global interest. We have around 750 million under management now. We have, last year we invested about 120 million, 70 million in new companies. We invested in 11 new companies and around 20 follow-on investments. We had about $1.3 billion from 4 large exits last year and a few others. Over the life of the fund, we're in the top quartile of all life science venture funds and have had the highest returns amongst life science corporate venture capital. And I think it's really paid off for Novartis. So we're hoping that on this basis we can continue.
Fantastic results, Campbell. We'll come back to this question about investing financially, strategically, et cetera, in the next round of questions. Let's bring in a perspective from Philips. Stephen, is it Seuntjens? Am I saying it?
Seuntjens, yes.
Fantastic, from the Philips Lifestyle Incubator. Welcome.
Thank you.
So Stephen, share us with you will. You're in the Lifestyle Incubator at Philips. Obviously, that gives you a particular point of view on this. Tell us about it.
Sure. Maybe just a step back for Philips overall. Within incubation, there's 3 areas. So I'm with Lifestyle, there's healthcare, and there's also the lighting area, and this mirrors the 3 sectors that Philips has. Overall, the incubation was set up in 2006. And why? For Philips, as a large company, companies are looking at growth, and there's many different levers to pull within that. So from that perspective, you can do M&A, everybody's moving into emerging markets, there's brand to work with, but how do you get organic growth, the breakaway things really moving? And that's why Philips had introduced and brought forward the aspect of the incubation. And within Lifestyle, everybody asks me, well, what's Lifestyle? And I always say, well, it's so vague it can be accurate, right? But Philips, one thing people may not recognize with who is Philips today, Philips is really a company of health and well-being. So within Lifestyle, we're focused on investing, and we invest both internally and externally in companies in the well-being space, and specifically more in things that help you keep you active in a more balanced and healthy way. We've released certain ventures have just come to market, such as Direct Life in the United States, that a number of corporations are rolling out amongst their population. And this is something that helps get people moving and tracks activity. That's just an example of well-being to bring it a little deeper into home. So we're set up globally. We source ideas throughout the world, and 70% of what we see is from the external world. The other 30% is from internal within Philips. So,
so are you able to invest in that 30% inside of Philips as well as the 70%
yes.
outside?
What happens is we do set up individual, and what we like to do, and as some of my colleagues here are people before have mentioned, we like to invest very early stage. So we like to get right in with the entrepreneur right when they have the idea and they're looking at, you know, I need some money, can you help me get this moving and going? And typically that's when we work with companies, anything from an idea to a small team, mainly pre-revenue companies we work with on that basis.
Fantastic. Well, welcome. Let's bring next Martin Kelly, a partner at IBM Venture Capital. Martin, welcome. Good to meet you. So Martin, introduce us to IBM's perspective on venture capital.
So IBM Venture Capital was established a little over 10 years ago, right at the height of the dot-com bubble. And
oops.
Thankfully, we had a pretty smart guy called Jerry Mooney who figured out actually, with a corporation as large as IBM, 100 billion, putting in millions into a venture fund and trying to get a return that moves the needle is quite difficult. So we take a slightly different approach. Sorry, maybe you can hear me now. We take a slightly different approach that we have invested in VC funds. We're investors in about 50 funds globally. And the reason we did that was we saw this as a great community for innovation and disruption and understanding what's going on in the marketplace. There's a nice quote which says, IBM doesn't release products, they escape. I think that's not just a problem that we have, but I think it's a large company problem, that the center of gravity for any large company tends towards stability, and startups and VCs are at the other end of the spectrum, and there's a huge amount of innovation that we can tap into as we look at each industry and look at ecosystem plays that we need to develop. So, you know, a good example would be a city, or we call a smart city, where if you were designing Barcelona today, you could use technology completely differently in everything from your transportation to your water to your energy. You can use software and sensors to make things much more efficient. And this is the grand vision that we have for how IT is going to move out of the back office into the real world. But to make that a reality, we need to find a whole army of partners. And we believe that venture capitalists and startups are the critical spark or magnet for making that, for pulling that ecosystem together.
So you don't have to invest directly in startups to work with them. You can get access to them through your investments in the VC funds and use that to begin to build the partnerships.
Absolutely. And there's many VCs that we work with we're not investors in. They want to talk with us and we want to talk with them. They're interested in selling us companies. They're interested in knowing where IBM is going, and vice versa. We're interested in seeing where they're going and potentially acquiring companies or looking at companies for partnership. So, you know, we do continue to invest small amounts as LPs, but you know, quite frankly, we work with lots of investors and startups who we have no financial investment in.
Thank you, Martin. Let's bring on Mark Harris from Intel. Mark, welcome.
Morning, Hank.
Mark, I think perhaps along with Novartis, you guys have been at this longer than just about anybody. So tell us about it.
Yes, it's been quite a while. Actually, the Intel Venture Capital arm is considered a strategic entity in the whole pipeline of trying to accelerate and advance innovation. And we see everything going from education through early seed funding, angel funding, and then real venture capital investment as something that can, on the one side, accelerate our own research outside of Intel, but also do some scouting for new ideas, for new business ideas within Intel.
It's fantastic, yeah.
And I think many of the colleagues here are doing the same thing. If you overlay a strategic approach and then the financial approach and do due diligence in both areas at the beginning, you end up with a good project that basically makes sense to invest in. So the investments have been quite successful. And if you're putting a strategic entity in place like that over 10 years, and we're running good returns on those investments, if you would be making a loss all those 10 years, then people would start to ask, is this really strategic? So that's one of the reasons why you have to do the due diligence up front.
Right, or it may be strategic, but is it sustainable?
Yes.
10 years of losses, I think after a while people might pull the plug and say, sorry, not every strategic initiative needs to keep being funded.
Yes.
So you've clearly met the test of sustainability. I think Intel's been at this a very long time.
Yes, thank you.
Congratulations.
Yeah.
All right, let's bring from Nokia, Isaac de la Peña, involved in internet initiatives. Isaac, welcome.
Thank you, Henry. Pleasure to be here.
So Isaac, tell us about Nokia's perspective on this.
Very good. Well, thanks, Henry. It's a pleasure to be here today. I'm heading Internet Initiatives for Nokia, which is basically about making sure that Nokia remains one of the most innovative companies in the world and that we provide the best mobile Internet experience that you can have. If you think of it, mobile Internet has been the technology that in the history of humankind has grown the fastest in the 5 different cycles of computer innovation that we have had in the last half century. Mobile Internet has picked up the quickest. And it's estimated that in 3 years, mobile connected devices of all kinds will overpass laptops in terms of volume in the market. And in 5 years, the main method of connectivity for people to the Internet will be the mobile device. So that's a huge opportunity for everybody, an opportunity that Nokia wants to realize, being the leader in mobile in the world. And we see venture capital as a way to realize that strategy. Realizing the strategy of the company and sometimes even advancing the strategy, investing in areas that will become important for the company 3-5 years in the future.
So there's so much exploding around you that as big as Nokia is itself, it needs to reach out to these other communities to keep up with all the opportunities in the internet domain.
Exactly, you're absolutely right. I mean, Nokia has been very forward-looking and very early on understood that you cannot create everything in-house. That's pretty much impossible, especially in a market that moves as fast and an industry that is as hot as mobility, that influences so many other industries. So Nokia started investing in venture capital as early as the mid-90s. And to give you an example of this forward-looking perspective, not many people know today that actually Nokia was one of the founding partners in PayPal. We were making the first investment in PayPal that then became as big as you know. Another good example is a company called M-Pocket doing marketing, mobile marketing, that we invested as early as the year 2000. And at the time that mobile devices just had black and white screens and only text formats with no images, which people were not believing you could ever do marketing there, and you can see what happens today, right? So we actually bought back that company in 2007, becoming our advertising/marketing arm at Nokia. So that was a clear
So you invested in it in 2000, brought it in 2007.
Exactly.
So I guess that's one that started outside and then came back in again.
Yeah, that's the full cycle where you actually do value creation and also the value capture down the line.
Yeah, fantastic. Let me ask the audience, how many people in our audience here this morning are working in a startup or a small business? Show of hands. Okay, that's probably 20% of the audience. Given that we have that interest in this audience, what can your organization, I'll ask each of you briefly on this, why would an entrepreneur come to you? What can you offer to the entrepreneur that a traditional venture capitalist might not be able to provide? John, let me start with you.
If I think about the opportunity to work with a startup company.
You're pitching them, not me.
And I think about the idea of coupling the energy, the passion, the vision, the innovation that's represented by the startup community or a particular investment opportunity, the opportunity that we would bring to working with a startup company is in terms of coupling the power and presence in the marketplace with the energy and passion of the team. When we look at ventures comes back to needing three fundamental elements. First, you need team. You need the people. You need those that have the entrepreneurial spirit and the determination to drive their vision, to drive the value that they believe that they can deliver to the marketplace. Secondly, you need infrastructure. You need the support to make it work, to make it possible. This is buildings, this is facilities, this is go-to-market channels, this is central functions to enable scale to go after global opportunities. And lastly, you need money. You need funding. So the team, the infrastructure, and the funding. And when we look at opportunities to invest externally, we consider all of these aspects, and we add to that the idea of strategic alignment. So people say earlier on, Hank, you touched upon, is it strategic investment or is it financial? Well, we believe it's both. We have a strategy to drive financial impact. We have a strategy to invest in those things that represent strong alignment with the application enablement and high leverage network strategy of Alcatel-Lucent, and believe that if we couple that with the innovation of an external team and the opportunity to augment our own portfolio, that represents the potential for some fairly significant impact in the marketplace.
All right, that was a good answer, but I want these answers to be shorter so we get more questions, so we can hear more. Let me ask the rest of you, not simply to restate the same things John did, but what can you add that's unique or different about an entrepreneur coming to you versus a private VC or, in this case, Alcatel-Lucent? Stefan.
So let me try to give a short answer. Basically, this may be a disappointment for some of you. We not always would offer money. So we would offer three things. One is a connection to a big company like Siemens, which is very crucial to many startup companies. The second one would be a development contract. And there I think we're kind of unique that we actually work together with startups without investing, but putting significant money into startups for developing something with relevance for Siemens. And the third is actually investing in early stage startups.
Let me just make a point here. For those of you in those startups, a development contract means you don't give up your equity. So if you're trying to stretch your equity and get a nice return at the end of the day for all your hard work, that's a great source of financing to advance your project without having to give up more equity. Great. All right, Campbell.
We'll invest early. And at the moment in life sciences, it's very difficult to get seed stage opportunities funded. We have a sister fund within the family of Novartis venture funds that will, like the Siemens unit, will make option deals. So you don't give up equity, but you'll get millions of dollars up front for the rights to a product that may not exist at the time of the investment that expires. And I would say that what is distinctive about our fund relative to many corporate venture funds is we have a very strict information firewall. We believe if you're going to lead rounds and sit on boards, you can't have information flowing through us to the corporate LP. So you get the benefits of the bridge to a corporate if you want it, but the information transfer only happens directly from the portfolio company to our parent LP. And we're an evergreen fund, so we can be patient.
So Stephen, assuming we have something we think connects to lifestyle, why would an entrepreneur here come to you?
I think for that very case, it being lifestyle itself, we're focused on the end consumers. And for those entrepreneurs that envision going global with their idea, Philips has the capabilities to really help that come true, from a lot of in-depth consumer market information to help you with, and the element of where we're placed throughout the world. So what we do find is entrepreneurs that think about their business out a few years and envision it being global, they often do want to come to us, Philips, because they're at a point where they need to scale their business, and we see a lot of people coming then. What we do tell entrepreneurs at a very early stage is, where are you at? where do you want to go with your business? And here's how we can help you.
So Martin, when an entrepreneur comes to you, they're not going to get money directly from IBM. So what will they get from you?
So last year we launched a new program called Global Entrepreneur. And as part of that program, in each city that we run, we look to five early stage companies and put those 5 companies together with 25 mentors. The mentors are VCs, angels, serial entrepreneurs, and some folks from IBM. And the purpose of doing that is that we believe that money isn't the only missing element here. We think there's skills and we think there's network is very important. And also we can provide technology. So out of that trial that we did last year, the 5 companies who came, 4 of them got funding, not from IBM, but through our partners. One of them we're working...
And you helped them get the funding.
We put them together.
Yeah.
And we put them together for a day and we let them loose on each other and make sure that, that the dialogue is constructive. And it's like a mentoring session. And at the end of the day, then they pitch in front of the audience and people are selected and awarded prizes. We brought the winners out to Silicon Valley and Boston in March to showcase them to the VCs out there. And we're actively working with them both in terms of us as a customer and us as a channel to market. So this is a new program. We're launching it in 7 cities this year. And we have the finals where we bring all the winners back together with all the mentors in November. So it's a very specific program.
Mark, I'm going to skip you for a moment because I have a reason to come back to you last in this question. Isaac, why would an entrepreneur come to you? And what would they get from you they wouldn't get from a traditional venture capitalist?
Yeah, very good question. I think that the main difference compared to an independent fund is that by coming to a corporate venture fund, you get also validation in the sense that the industry considers that area as important and is something that you want to invest on, and that eventually you're working with somebody who can become a partner, a licensee, or even acquire down the line. And that's very important for a company that is working with a lot of risk. Now, there's also the downside to that, and there's this perception that having an investment for a corporate investor can be the kiss of death for a company, because then nobody else in the space will work with you because you have already been tainted with being in the area
you're
of
a Nokia venture.
Right, right. You're a Nokia fund. You obviously won't ever work with Motorola. And that's a bit of a myth. That can happen, but that depends on the sophistication of the fund. And I can say for Nokia that that's not the case. There are many examples in which we invested in a company that has spillovers on many other people in the industry, in the mobile ecosystem.
PayPal did all right. They got over that stigma.
Exactly.
Mark, the reason I wanted to say you for last is that not only would entrepreneurs come to you at Intel, but Intel is actually going out looking for entrepreneurs. This program you've organized at Berkeley to go out and teach entrepreneurship in many different countries around the world, some of which are some of the new growth markets for Intel's own business. So you've really been out cultivating relationships as well as fielding inquiries from the entrepreneurs. Tell us more.
Yes, we're trying to advance or accelerate innovation out of many different reasons. One of the reasons is trying to get economical growth in some of the emerging markets that we're looking at, but also trying to get research going in certain areas that are not moving as quickly as we would like to have it move. In some cases, you find that there are very good technologies out there that are maybe not going to survive, so you want to make sure that those technologies kind of make it over the hill and manage to go into the market. The whole pipeline is important because you can't just start off, if you're looking at specifically at the emerging markets, you can't just start off trying to invest because there's nothing really there yet to invest in. And so you're really doing creation in those markets. You're creating an entrepreneurial environment, you're creating then the pipeline and you need to also then collaborate with many of the investors that are starting to come into the emerging markets and help them become more interested in it. And having a large corporate investor as a backup helps them to take those risks. So a typical Intel capital investment is, I mean, the rules are always broken, but a typical Intel capital investment is about 10% of a company. but only if we find 2 other investors to come in. So we also help diversify the investment. That helps put some, risk sharing for some of the new investors that are coming in. And we're not trying to take control of the companies, of having a real high investment. We can add capital, that's one part. But very similar to my colleague here, we also try to do coaching and giving them access to our international global network, insights into what types of things have already been developed. I mean, the amount of recreated wheels around the world in this area is just immense, and it's good to tell them early. Yeah. So yes, so it's a pipeline that we're trying to create and accelerate. There's in the audience, I know there's a lot of the collaborative partners that we're working with around the world. So it's heavy lifting, but in the end, it will come back in research results, in new business opportunities, and in business. Because if the economies are becoming vibrant, then the business will happen.
I think by way of summary, what I would say here to the audience is that as an entrepreneur, of course you need money, but what you really need is smart money. You want smart money that's going to help you get connected, that's going to get you access into the networks you're going to need to connect to be successful. You're going to need access to the skills and experience of others that are going to help you make new mistakes rather than tripping over the mistakes others have already made before you. So as you're thinking about where to go for opportunities for funding yourself, think about the smart money, not just the first money that comes along, because there's a big difference in getting people who really can help you build your business from somebody who simply writes you a check. Now let's turn to another issue that a few of you have already touched on, and that is one of the unique aspects of corporate venture capital is, of course, you're looking for a financial return, but you're inside a corporation. And your corporation is giving you a salary because at the end of the day, to use John's word, you want business impact on the corporation. So the ventures are a means to the end of enacting a corporate impact. And so what I'm interested in this next round of questions is, what do you do to get that corporate impact on the one hand, and what do you do to protect your ventures from being squished by the corporate side on the other hand? Because as we all know, these corporate agendas can be fairly heavy-handed sometimes, and small ventures don't always do well in that environment. Campbell, let me start with you.
So the first thing that's been touched on a couple of times is sustainability. And if one of the challenges, there has been a stigma with corporate venture capital with a lot of the independent venture firms and with entrepreneurs. And a couple of reasons that the stigma has existed is that across a lot of corporations, corporate venture capital has tended to follow a sine wave course where corporations tend to go in when the market's hot, which is exactly the worst time to buy. The market crashes, the corporate venture fund unit loses a lot of money, the unit is shut down, everyone's fired. And right at the time when the entrepreneurs and the other independent VCs needed their corporate venture or any venture colleagues most to help keep the syndicate strong and to help support strong companies and take them forward through those tough times. And I would say right now, as an example, the economy at the moment...
We are in those times right now.
We're in those times right now. And it's very difficult to get, for the entrepreneurs who are starting a company, you're probably finding it quite tough to get money right now. And the reason is because a lot of the independent firms and corporate venture firms are having to protect the syndicates they're already a part of and having to keep those companies moving forward. So to invest in a new company, the hurdle is particularly high right now. So I think the first job of any venture capitalist, whether they're independent or corporate, is they have to make their limited partners money. And they have to return a higher cost of capital than whatever the hurdle is for that investor. So for my firm, or for our LP, NOVARTIS, the cost of capital is around 10%. We must beat that. And in fact, we aim to beat or equal the return of the most profitable part of Novartis, because it's a diversified company with a number of different units, and that's Novartis Pharmaceuticals. So I won't tell you what that is, but it's quite high. So that is our goal, which is to be as profitable as the largest, most profitable division of our LP. The second aspect, I would say, is your real question was, how do you make an impact for the corporation?
On the one hand, and then not get your venture squished on the other hand.
Right. So we're very open with other parts of Novartis, and we're a small, tiny unit, just 8 people, 750 million under management. So relative to a Novartis makes somewhere 8 to 10 billion a year in profits. We're tiny relative to the greater mothership. The first thing we tell them is we're trying to invest in the white space where you are not. If we're investing on strategy for Novartis, that's an accident. We really want to invest in things that are going to change the world and are probably too far ahead and too risky for you yet. If we're doing our job in 5 to 10 years, you'll suddenly realize that there has been a new technology, a new approach, a new way to cure or make patients better, and we will provide you a seat at the table. You won't get anything cheap through us, but at the time that our portfolio companies, and even companies that may not be within our portfolio, but just through the network of getting to mix with the other venture firms and entrepreneurs, at the time those companies are ready for a collaboration or an exit, they just have to let one of us in the team know, and we will get you a high-level meeting with Novartis. We'll also actually do it with most of the other major big pharmas. We have very good connections at CEO level with companies like Sanofi, Roche, GSK, Lilly, but we'll definitely make sure that Novartis has a seat at the table. And then it's between the company and Novartis.
Fantastic. So again, great answer. We need to get them a little shorter just because we're going to be out of time before we get to the end of this. Stephen.
Okay. As far as impact, I think impact is a good word. I'm gonna change that to a wow factor. That's what we say, a wow, something that is very new and breakaway and does move the needle in innovation into a new space. That's really the mandate of impact for us. And I think how do you keep new precious businesses from being squished in companies is a great question. And for me, it's where are you structured and how are you set up in the company itself? What is the governance in the company? So do you have a mandate where these new businesses can operate independently and yet, as I say, go into the kitchen and pull out some of the goodies that can help them without being forced in that direction to do so? And so within Philips, the governance that we have is right at the top of the company. We have a board we report into, and that alone in and of itself gives clarity to the company of the importance of what we're doing, and also the independence factor to be able to make things happen for these small companies and keep the company away.
Yeah, it really is impressive that you're reporting in at the board level. That's actually quite unusual for corporate venture firms to be reporting that high up. Martin, how about you?
I think the challenge that all corporate ventures have is that for a large organization, venture capital is always going to be a small part of it and will never move the needle. So you need to look at it in a different way. And we look at it in terms of what is it going to do to drive our business in terms of revenue through ecosystem plays. So we do a lot of work to track what that results in. So 35% of IBM's revenue come through partners. So that's a key part of it. We also look at it in terms of, showcase examples of innovation that are going to change and deliver the corporate strategy around smarter planet. So examples of companies that are showing, here's how we change the energy grid, here's how we change the water system, here's how we change the transportation system. So that's how we try to make it strategically relevant. In terms of protecting these young, early-stage companies, we don't look for exclusivity. We say to the entrepreneur, look, IBM is a big organization, but you have to build your own business, and you have to look at what makes sense for you. You have to try and take it in that regard and say, okay, well, it's not about just us as one partner. You should be looking at other partners and other customers as well.
Mark.
Well, I think one of the focuses by trying to diversify the investment also protects somewhat the young entrepreneurs. by having 3 different investors coming in, also bringing in board seats, et cetera, that helps kind of protect from the big corporate viewpoint. We also have Intel Capital as a separate legal entity to Intel Corporation, which protects them from the business units within Intel from trying to, let's just grab them and, incorporate them. We've, over many years, in mergers and acquisitions, have done a lot of those and have made a lot of mistakes by trying to integrate companies too early. You have different cultures, culture shocks, and basically by trying to integrate them very often, you hinder them from growing in their natural environment. So that's kind of, we try to put them out on a green field and let them survive.
So Isaac, your comment in part stimulated my question here. How do you wrestle with the problem you kind of raised in your earlier comment of advancing the strategic interests of Nokia while not getting the venture squished in the process?
Right, and that's really critical, where you report in the corporate structure and how do you realize that. That has actually more impact on the success of that fund than, I would say, even talent or the investments you make. That's really important that you are not understood as R&D, that you're not a loss center. You're definitely there for making profit at the same time that you realize a strategy, but you're not a business line either. Because a sure road to failure is applying to you the same metrics that the company applies to a normal business unit in the company, because you have different cycles and different maturity. And definitely you are not charity, you are not corporate social responsibility, which actually happens very often that a company is realizing good returns in an industry, doing corporate venture capital, and then everybody wants to jump on board. And if my competition is doing it, I need to have my corporate venture arm. And that's definitely a road to failure. Because
that's where that sine wave comes from that Campbell's talking about,
right.
that as the money's building up, it starts to look really good to a lot of those new companies, and then people jump in.
Exactly. So it's very important at which level you report to. If you're at the board level, fantastic. If you report to the CFO, may it be a sophisticated CFO that understands the maturity cycles of venture investments. And I would say that if you look at corporate venture capital in the whole environment of open innovation, you know very well, Henry, that open innovation is about opening the firewalls of the company and getting innovation in and getting innovation out. And the big question is, well, what's the competitive advantage? If you are not anymore the sole generator of innovation in the company, everybody potentially can do that in the industry. But still, culture and processes and the structure remains a key factor of performance for corporate investments, and that's something that is very difficult to replicate across industries and across companies.
Yeah. John, you started us off in your first remarks about the importance of business impact in the mantra you've got now. How do you deal with these issues of delivering impact to the corporation and not having the venture get caught up in the strategic agenda and miss financial opportunity?
Yeah, when we think about impact, of course, we think about the impact of new products, we think about the impact of new businesses, we think about financial impact, and we have to recognize that that's what we're driving, but at the same time, we have to think about softer terms like nurturing the venture and cultivating the venture and protecting the portfolio. And the answer for Alcatel-Lucent Ventures rests in a phrase that's common to many of us, laser-like focus. Having a laser-like focus. It's the mantra that we hear from many great leaders. President Obama talks about laser-like focus in terms of the job crisis and addressing that. But in that phrase, we believe in Alcatel-Lucent Ventures and Bell Labs that there's a hidden message. Laser-like focus. Well, what about a focus on laser-like innovation? Innovation of breakthrough technologies like the laser, like the transistor, like the CCD sensor, like the Unix operating system, C programming language. These are all tremendous innovations from Bell Labs that resulted in not just new products, but entire new industries, the creation of new jobs. And so understanding the broader impact that can take place, you have to very much discipline yourself to not let the great ideas die, to support them, to maintain their relevance to the corporate agenda in terms of their strategic alignment, but also understand the broader potential in terms of the creation of new value for your customers' customers, job opportunities for your employees and your recruits. And I think if you maintain a laser-like focus on your relevance to those various agendas, it provides you with the potential to be in the game, to have that one venture that can change the game, that can help you win the game, and support your continued investment and your continued existence as a corporate venture organization.
Stefan, we've got just 1 minute left. I saved you for last because my sense is you've really thought about this issue hard in your setup of TTB.
Yes, we definitely did. And I just want to mention two...
But we have only 1 minute left.
Yeah, no, I'll be fine. I'll be short. 2 points which I think are important. One is conflict of interest if you do that venture investment, which means that we as an investor, we have to look after the startup company. And if the startup is negotiating, let's say, like a contract with the big company, you need to basically have 2 people in charge to do that. That's very important. The second part is also to bridge sort of the startup world with the big corporate world. And just to give you one example, so we had a startup in the wireless traffic monitoring, and they brought their product to the Siemens mobility side, and they looked at it, and it wasn't German engineered, and it wasn't perfect, and things like that, and they sent them away initially. And one thing we achieved actually is to get them back and connect them a second time, because the first time it actually didn't work. And the startup, and that was kind of the crazy part of the story, is the startup in the meantime was independently successful. So they sold in 20 states in the United States and in 10 countries outside, and Siemens sent them away in the first place. And so I think from a connectivity point or connection point of view, it's very crucial to kind of accept that the living in a startup is very difficult to living in a big company. And sort of to bridge that world, I think that's one of the very crucial issues here.
So I would say by way of summary here, many of us think of large companies as these monoliths that are frankly giant all around and are impossible for small companies to work with. What you've heard here this morning are 7 different companies with slightly different approaches, but all of whom are open for business and eager to partner with, collaborate, support, and even invest in small companies. And by way of closing, I would say that a phrase I heard from Les Videz at Intel, who really started the corporate venture activities at Intel, the only way you're ever going to be a big company is to learn how to work with big companies. And here are 7 who have created processes that are very eager and willing to work with you. Please join me in thanking our panel.